To watch the full lecture of all subjects, kindly subscribe to my YouTube channel and press the bell icon because whenever I post the new videos, you will get the immediate notifications. Hello everyone, welcome to my YouTube channel. In this particular video, we'll discuss one more problem regarding ARR, accounting rate of return. A project requires an initial investment. Initial investment is also called as original investment of rupees 6 lakh. So for a problem, they have invested 6 lakh rupees for a project and have scrap value of 30,000. So scrap value is also there, 30,000. Then the life is 5 years because scrap value is after 5 years. That means the life of the asset is 5 years. If it's net earnings after tax means CFADAT. You may ask me, they have told only after tax, but why did you take after depreciation? See, before deducting the tax, first we will deduct depreciation. So when they have deducted the tax also, it means that depreciation is also deducted. So it is CFADAT. And to calculate ARR, we require CFADAT only. So 5 years cash inflow they have given 50,000, 70,000, 80,000, 60,000 and 10,000. From this information, we need to find out the accounting rate of return. Let us try to solve this problem. So first, step 1 will be calculation of ARR. So ARR is equal to, by this time you should be familiar with the formula, average annual CFADAT divided by average investment into 100. If you do this, we will get ARR. So for that, first we need to find out average annual CFADAT. So average annual CFADAT will be total CFADAT divided by number of years. Total CFADAT divided by number of years. So now total CFADAT. For getting total CFADAT, add all these things. 50,000 plus 70,000 plus 80,000 plus 60,000 plus 10,000. When you add everything, we get 2,70,000. So I will write here 2,70,000 divided by life they have given in the question, it is 5 years. So number of years is 5. So 2,70,000 divided by 5 will be 54,000. It will be how much? 54,000. So this is average annual CFADAT. Now the second step we need to calculate is average investment. The formula is original investment minus scrap value divided by 2 plus working capital plus salvage value. Now let us check. Original investment. How much is the original investment? Original investment is 6 lakh rupees. Original investment is 6 lakh rupees minus scrap value. Scrap value they have given it is 30,000 minus scrap value 30,000 divided by 2. Now working capital they have not given in the question. So when in question working capital is not given, this particular equation you need to cancel. So the formula will be only OI minus original investment minus scrap value divided by 2. So 6 lakh minus 30,000. 6 lakh minus 30,000 will be 5,70,000 divided by 2. 5,70,000 divided by 2 will be 2,85,000. So the average investment is 2,85,000. Now we can calculate ARR. So what is the formula to calculate ARR? The formula is average annual CFADAT divided by average investment into 100. Now average annual CFADAT is 54,000. It is 54,000 divided by average investment. How much is the average investment? 2,85,000. 2,85,000 into 100. So 54,000 divided by 2,85,000 into 100. When you do that, you will get 18.95 percentage. So 18.95 percentage is ARR, annual rate of return. So this is how we will solve the problem. Hope you have understood how to solve the problem. If you have understood, please put in the comment box that you understood. If you have any doubts or queries, then please put your doubts and queries in the comment box so that I can respond to your doubts and queries as soon as possible. Thank you for watching the video. I'll come back with the next video. If you have any queries regarding today's session, kindly send your queries to education.mbroadcast@gmail.com.